Hi everyone, my name's Amber Kanwar. You might recognize me from the 15 years I spent as an anchor and reporter at Canada's Business Network. Every day I would come to work determined to deliver the best market insights for our viewers. I've always worked hard for you, and you made it very clear you want more. So I'm back with a brand new podcast to help you make profitable investment decisions. Every episode, I'm going to sit down with the top portfolio manager. We're going to talk about the markets. We're going to take your questions. And at the end of the episode, they're going to give their 3 best investment ideas. So if you want institutional quality advice, tune in and submit your questions. You can get in touch inthemoneypod.com or follow us on Instagram, X, Facebook, and TikTok. Together, let's make your financial journey a little more in the money. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Hi everyone, welcome to this episode of In the Money with Amber Kanwar. I'm so excited because this episode we are going to talk about energy. And there is so much going on. There is the threat of tariffs, and this is really holding back Canada's energy sector. Oil prices have actually done pretty well over the last couple of months, but energy stocks in Canada haven't done anything. At the same time, there's big political change that could be happening in this country that could potentially be beneficial to the sector. So there is a lot to unpack, and we've got one of the best to unpack it with. We've got Eric Nuttall joining me in my podcast studio. Eric Nuttall, of course, of 9 Point. Thanks so much for joining me.
My pleasure. So happy to be here.
So I know you don't look it, but you've been doing this a very long time.
Long time.
Is it 20 years? More than 20 years?
Yeah, 22.
22 years. You look like you're 22. So 22 years doing this. Yeah. And I think everybody knows Eric Nuttall's the energy guy in Canada. But how did that start? Because were you finance first and then you stumbled upon the energy sector as a specialty, or was it energy first? How did you become Eric Nuttall, the energy guy?
Energy was a fluke. So I started at Sprott Asset Management in 2003, right out of school. I went to Carleton University. It was a heck of a journey just to get in there because Carleton's not exactly a name brand university then, nor is it now. So, a lot of the big banks were hiring from the Ivies kind of thing. But they took a shot. Eric Sprott, my original mentor, was bullish on oil at the time. He believed in peak oil, so not peak demand, but peak supply. This is going back to 2004. So we launched the Sprott Energy Fund in 2005, helped him set it up, covered energy stocks from 2005 to 2010. And at that point, I started to slowly gain responsibility for the fund. So I think mid-2010, I got the entire fund. So it's been 15 years of having that fund. And we did a management buyout from Sprott in 2017. They're known for their gold prowess. So they decided just to be a pure focus on gold. So we did a management buyout at some point in 2017. So the fund that I have now, it's effectively the same fund. We've been on the same floor going back many, many years.
Okay, so that's a really long time, but it also spans cycles where people completely gave up on energy investing to the point I remember, I'll never forget this, and I won't name his name, but he was an energy investor. Then things got really bad. Must have been around 2014. There's been a lot of times.
Few of them, yeah.
I want to say this was 2014, 2015, when things were so terrible. And he was talking to me about Hermes. That's how much he had just had to find another reason to manage money in the country, and it just wasn't going to be energy anymore. Yeah. You've never boned up on Hermes.
No, I've not. No, this has been a game of survivor. It's been really tough. So since 2010, from when I took the fund over, we've gone through hard landings, soft landings in China. We've seen the rise of U.S. shale, which has been massively disruptive, which I'm sure we'll speak to. The sunrise to now the twilight or sunset of that. We've had to deal with the biggest demand shock in history from COVID, where demand fell as much as 24 million barrels per day, as much as 30 million for a short period of time. We've had to deal now with a weakening Chinese economy last year. But the biggest thing has just been sentiment. We've suffered from really profound sentiment shocks, which each one kind of chips away at the willingness and desire, I think, of investors to look at this sector, especially at years like last year where other sectors are doing much, much better. So it's become volatile, it's become complicated. And for somebody in my seat, it has been a game of survivor. And there's two of us left in Canada.
Why? Why do you stick it out? You could, like, as you said, you're a money manager. You could go to other sectors.
I could. I've always been a believer in being a specialist. It's much harder to compete as a generalist. And if you can command a space, do your best to understand it better than others, there's a massive opportunity and fortunes to be made in that, both for yourself and for your clients. So, and I love energy. It's always been the wimp kid that gets picked on, so to speak. People love to kick it in the shins. This East versus West Canada tension. So you have this sector, and it's the driving engine of the Canadian economy, but the majority of the country just doesn't understand that. This ignorance pervasive in terms of the role that oil has in our world. We couldn't be doing this without it. People thinking that it's peaking anytime. So it's hugely, massively important to Canada. It's massively important to the TSX. And Eric Sprott, who was original mentor, instilled in me, look where other people aren't looking, because you can find like multi-baggers. He was always looking for multi-bagger stocks going to go up several times. And we found 20 baggers, 30 baggers, et cetera. I would be challenged to think of any other sector where you can find so many opportunities than in energy. It's just no one's looking. And, I've said before, I don't understand why people can't see what we see at times. And I think people have just given up on this sector. So, where there's an absence of focus, there's a ton of opportunity.
Okay, so one of the reasons that energy has been taking a hit, oil in particular, has been because it's about emissions and it's about the environment. And I don't think I've ever asked you this. Do you believe in climate change?
I don't think I'm allowed to publicly say that because my views represent those of my firm, et cetera. But my personal view is, I think that the climate has been changing since the birth of Earth. It cools, it warms. Do people, peoplekind, do we have an impact on climate? Probably. Are there other elements to that as well? Yes. But the reality is our entire world runs on hydrocarbons. There are no alternatives. There is no transition. So there is no energy transition when the demand for oil, natural gas, even coal continues to make all-time highs. So that's just our reality. And so it comes down to, if there's no substitution, then as a consumer and as a citizen of a country, who do you want to supply that energy? Do you want it to be Canada? Do you want it to be Russia? Do you want it to be Iran? Because somebody's going to do it. So if we can do it in a safe manner, environmentally responsible, where we don't poison, when we talk about pollution, I'm talking about like real pollution. We're not polluting waterways. And as an industry, we can lower the emissions intensity through either sequestration, so capturing it, using things now like solvents, which is just injecting another form of fuel into a reservoir, so you don't have to burn as much natural gas to heat it up to make it mobile, et cetera. And so the energy sector, I think, doesn't get credit for being the largest investor in clean tech of any other sector in Canada, committing, if government participates, to reach net zero by 2050. So they can maybe do it. As a country, we certainly can't do it. 2035, 2050, you pick the goal. So yeah, I believe in climate change, but just to blame it on people's short existence and exerting this massive influence. And it's frankly a fear-based tool that politicians weaponize. So this whole the world's on fire nonsense. The science is not settled, and it's hard to find. But
the trends about warming are clear.
Sure,
the planet is warming.
Sure, and it's warmed before and it's cooled before. So it's just, let's get back to it's hydrocarbons. There is no substitution. Wind, solar. Well, how do you replace plastics and chemicals, lubricants, cement, everything around us? Everything we're largely wearing at times involves or is using hydrocarbons. So it's too easy to say, we need to get off and we'll just drive EVs and, ban plastic straws and that. That's not our energy reality. We can go into the demand for oil, certainly natural gas, but oil, because it's more contentious. is going to grow a lot longer and stronger than people believe.
And so with that in mind, I mean, you've got some support in the White House because the thinking is, he's aligned in your views there, President Trump, and as he goes through his inauguration this week, that he's going to be positive for the U.S. energy sector and might pull back on investments in some of those renewable technologies. But then there's a question of what does that mean for Canada? Mm-hmm. Because there's also the threat of tariffs. Now, the latest report suggests that he's going to slow walk those tariffs. It's not going to be an immediate 25%. And I think there's still lack of clarity as to whether or not Canada's energy sector is going to be exempt or included. So there's so much uncertainty, but there's a risk. How do you deal with that as an investor?
Yeah. So uncertainty creates massive opportunity. And to use logic and political decision-making in the same sentence is not always a good thing. But our belief has been, and those who we speak to, so we do our best to speak to the most informed people. We have an army of consultants, advisors that we use. So one person is ex-White House. He was in prior administrations. We get to talk to energy CEOs whom spend a lot of time, or at least they used to when there was a functioning cabinet, to try to get informed views from certain political actors because there's a wide spectrum of ideas within the current cabinet. We'll talk about the next cabinet. So you have to use logic to say, okay, what do you think is going to happen? There's fear of what if, a lot of if-thens. So our belief is that tariffs will not be applied onto Canadian oil. And there's a few reasons to believe that. One is we are their largest source of safe, reliable, and cheap oil. There is no substitution for Canadian heavy oil from anywhere in the world. It's that size. When you look at, so we're 60% of their imports. We hear a lot about U.S. energy independence. That's a fantasy. It always has been reliant on Canadian oil. When you look at areas of refineries, like all of the refining complex in the United States was created to process Canadian heavy oil. So if you process light oil, you don't get nearly as much of the same yields and products which they need. When you look at PADD 2, which is kind of like Chicago, Midwestern United States, they import 3 million barrels per day of Canadian oil via pipelines. So it's not like you can have freighters come in and truck it up. So it's non-substitutable. And our view is, and there's still uncertainty on this, but any increase in input price is a direct pass-through to the U.S. consumer. So here you have Trump, he wants low rates, he wants low inflation. Well, that's the most visible cost of living is when an American pulls up to the pump, fills up their pickup truck, and it's right there. So are you going to allow an immediate, meaningful increase in that cost? So I don't think tariffs will be applied. If they are, it would be very short term because that cost pass-through would be much more obvious. My understanding is Trump is getting counsel. Obviously, Premier Smith is doing a phenomenal job going down and trying to educate the team
Alberta's
around.
Premier.
Yes. You have the new energy secretary, soon to be new energy secretary, Chris Wright. He was the former CEO of Liberty Energy Services, a fracking company. He's literally written a book on energy literacy in terms of why, alternative energies are a joke and there's nothing at scale and all these different things, the role of hydrocarbons. So I think Trump, there's a lot of bluster. Is it a negotiating tactic? We will see. But from the people, the best sources of information we can get, oil and energy will be exempted from any tariffs if tariffs are applied.
So, that's so logical. And the question is, what if logic doesn't prevail or logic doesn't resonate the way everybody thinks that it logically should? You mentioned that there would be a short-term impact. Mm-hmm. Given that Canadian energy stocks have already lagged the move in oil, how much of it is already priced in? How much downside do you think that there could be?
So I think there would be a knee-jerk sell-off. Goldman Sachs report out this morning was saying that 40% of it is being discounted, 40% of the move. They said, it's like 15%, but none of us truly know. Like literally the most informed people I can get access to, nobody knows.
They don't know. That's what I mean. Isn't that kind of, that's the risk. It's really hard to handicap.
There's always risk.
Yeah.
But you've got logic, plus you reference, there's been almost a 10% lag between Canadian energy stocks and U.S. energy stocks with this rally in oil, which has not been on tariffs, it's been on sanctions, which we need to talk about. New sanctions on Russia, kind of a parting gift of Biden to leave to Trump, which he can't really walk back because it involves Congress to do so. We've got meaningful sanction enforcement coming on Iran, which will have a very significant impact, maybe even Venezuela. So, and that feeds back to tariffs. Well, how do you tariff Canadian oil, make it more expensive force refineries to try to find another source. And then you're also going to put sanctions on Venezuela, which is the only, other heavy substitute for us. So there's a lot of reasons to believe that it won't. If it does, you'll get a knee-jerk sell-off in the entire Canadian market, because we are, let's not kid ourselves, who has the power in this negotiation? Mm-hmm. It's not us. So what we look at is you've got a 10% lag in Canada versus US with a rise in the oil price. When we evaluate, even if, let's say it's a cost, the Canadian producer has to eat the cost. When we look at balance sheet strength, free cash flow, we still have some names where they would fall from current spot, they're trading at a 25% free cash flow. Okay, it falls to 15. Well, at 15, it's still very, very attractive. So broadly speaking, we can still find a lot of opportunities. Plus, there are names there's some condensate producers in Canada. So condensate is a light oil. It's used in oil sands to blend to make it be able to move through a pipeline. Well, that's produced domestically, consumed domestically. And for some companies, that's 60% of the revenue or more. So you can find opportunities in an environment where there is uncertainty. And honestly, those are the types of opportunities we want. So on Thursday and Friday, we were adding to the most beaten up names with the most exposure, where we can model it out and say, okay, what is the worst case? And as best as we can figure out, what is it discounting and what does it look like under the best case and the worst case scenario? And is it still attractive in either? And we're finding a lot of opportunities.
Okay, and we're going to talk about those. I promise everybody. We're going to name names and get some of his best ideas. Before we do that, you mentioned there's global politics, there's sanctions on Russia that have been supportive of prices to here around $78, $80 per barrel. I've heard you say you don't see much upside on price
short-term
from here, short-term, and that's fine.
Yes.
You can still buy stocks. Let's talk local politics. Local being Canada.
You're trying to get me in trouble today. Climate change, politics.
I know. I'm getting it all out. These are all the things I've wanted to ask. I just never had more time. So Trudeau is out. I know that you're thrilled about what that means for the energy sector. But how much can a change in politics really counteract? Because as you said, Canada's kind of powerless in this.
Yeah.
So even if there's a change in government here that is more pro-energy, does that really matter? Is that an investable event?
Massive. So I think my own personal belief is all the polls would suggest we're going to get the largest conservative landslide victory in the history of Canada. What that means is the ability of foreign investors to reevaluate Canada again. And the reason I believe that is the Monday of the announcement of Trudeau's resignation, I got an inbound on LinkedIn from an entity that sold a multi-billion-dollar package in the United States, smart guys, and they say, look, we've got capital, we've got investors, we're looking at Canada now, and your name's come up a lot, let's have a talk. And we talked later that week. So it's not necessarily what can a new government do, it's eliminating the risk of what the wackos currently might do. So when we think about windfall profit taxes, my understanding is that was heavily debated several times within cabinet, and there was actually a better than 50% chance that it was going to be enacted on Canadian oil and gas, like a windfall tax. So it's those types of things. It's an emissions cap, which is really a production cap. It's windfall taxes. It's all of these things that it's too risky for foreign investors to evaluate. Capital is mobile. It can go anywhere. And so why, if you have that risk, we've just seen that impact valuations. When we look at some of our senior Canadian companies relative to their US peers, they're better businesses. They have more inventory, decades versus years, better quality, equally strong balance sheets, an equally strong, if not stronger, commitment to return free cash flow back in the form of share buybacks, but they're trading at a 2 to 3 turn discount. Well, why is that? And I think it's that political risk discount that's been applied, which maybe it's May, maybe it's later, should be eliminated.
Okay, we're going to talk about specific opportunities now. It's time now for the In the Money Mailbag feature. Let's get to some of your questions. Okay, our first question in the mailbag is coming from Time Value on X. This is about Canadian natural resources. Can we talk about CNQ? It looks like it dumped about 6% in the past week. Is there anything wrong with the company? And like we could talk about how it dumped in the past 6 weeks, or in the past week, but I also think it has just lagged generally the move in oil, but in other oil stocks as well.
Yeah, so it was a very popular stock in 2024. So it's been a sentiment challenged environment. For those people that many investors, generalists, institutional investors have to have energy exposure. So where have they been? It's like, okay, where can I hide? So they hid in infrastructure stocks, which were massive performers last year, also with the rate environment, and they were hiding in CNQ. And so if there's ever an event where people want to reduce either energy exposure or a Canadian exposure, what do they sell? They've been massively selling CNQ. And there's a big pair trade right now where people have gone long Suncor, short CNQ because of tariff concerns.
Well, and Suncor is a bit of a turnaround.
They've turned around.
They've turned around, yeah.
And honestly, Rich Kruger, this may be the fastest turnaround in Canadian history. He is a phenomenal guy. Like, it's unbelievable how quickly and the quantum of improvement that he has had. So I think people are using Suncor as a safer vehicle because they've got refineries, Eastern Canada, well run, et cetera, and they're not as exposed to tariff risk versus CNQ. We short term at least, we did a big trade last Friday where we trimmed our Suncor and we bought CNQ. So CNQ is about a max weight for us now because of the massive lag, because it's our fund. I wanted, again, there's uncertainty, but I wanted meaningful exposure in the event the tariffs do not become enacted, because we don't believe, for all the reasons that we thought. It's been a huge laggard. And sure enough, right now it's up 4% on the headlines that we're seeing. So it's still mispriced, we think. Like, we look at a company of its stature, run by Murray Edwards, and we've got it trading at pick your oil price, but a current spot at 6.7 times. Their US peers are like 8 to 9.
So it's undervalued.
Massively undervalued.
Underperforming, you think it could benefit from a rotation?
Yeah, there's a catalyst to re-rate it.
Okay, you knew this question was coming. This is our second one. This one from Deborah in Okanagan Falls. Baytex.
You warned me about this one.
I know. Yeah. You got to atone for it. And I know that it hasn't been great for you either. Deb says, I'm an investor in Baytex and I feel like I've been living in a dark tunnel for quite some time. Yeah. Is there a light at the end of my tunnel with Baytex? Do the fundamentals and geopolitical environment support me continuing to hold the stock? Can we backstory this a little bit first? Like, so what's gone wrong at Baytex? Why are you on the hook for it?
Yeah, why am I on the hook for it? So we no longer own it. We can touch on that.
You sold it?
We did.
Oh, gosh.
Part of the reason was we had...
Is that breaking news? Have you told anyone?
Might be. Okay. I think that is breaking news.
Breaking news, Eric Nuttall sold his Baytex.
So we trimmed some in December. We needed tax losses because we had, for a mutual fund, when you've realized gains, you have to pass it on to your unit holders. So by year end, you have to do your best to mitigate that tax consequence for your unit holders. It was one of the names where we had a loss. So we did trim it. We sold the last of it. We've had last year, the fund was fine, but we did lag our index, which is our primary benchmark. And my view at the time, things have improved a little here, but if you remain in a sentiment challenged tape and where there's an absence of meaningful buying, if you have a name that is underperformed, like, will the winners keep winning? Will the losers keep losing? And so the backstory in Baytex was you had a company under a new CEO, Eric Nuttall, very dynamic guy, good vision, what he wants to do with it. They increased their exposure in the Eagle Ford, which is a play in the United States. They thought they were getting it at a very discounted price. And at the time, it was viewed that the person that held the assets were drilling really crummy wells. My partner is a geologist. He spent a lot of time with their technical team. He flew down to Houston, met with them. And our view was the quality of the asset was much better than what the market believed, and they got a steal. In exchange for them buying that acreage, they issued stock to a private equity company. And one of my bigger lessons in life has been be very cautious when there are these large overhangs. Like Tamarack Valley was another name of ours, where they were executing, but there was just constant wall of stock coming to the market. And so for Baytex, you've got now a private equity guy that owns just over 10%. Our view was, is it going to be sentiment challenged tape? Maybe, maybe not. They're executing Baytex. They're doing what they told us they would do, but the stock continued to suffer. And I have other names where there's more visible catalyst to drive a re-rating. And if we ever want to buy the stock back, I know who to pick up the phone and call, because there will at some point be liquidity. So that was our view.
So nothing operationally challenged. No. It's just kind of a financial structure, top holder. you had to get out because of the way your fund structure was, but if this private equity investor was looking to sell, it might be more attractive to you.
It could be. It's a type of name where it's seven. No, again, oil was in the 60s when we sold, high 60s. Our view is they need about $75 for the free cash flow to be meaningful enough to excite people. They have high sensitivity to their free cash flow, free cash flow to a rise in oil. So if you were a believer, as I am, 70 to 80 is the band that we think this year. Maybe a little higher, but oil was in the 60s. We kind of lost that high conviction that we had.
And are they exposed to that price, the American price? Or are they also hit by the discount in Canadian crude?
It's a mix. So they've got Eagle Ford, which commands a bit of a premium depending on the day. You've got heavy oil that sells at a $14 discount depending on the day. And then you've got light oil in Canada, like one of their drivers is the Duvernay, which is kind of like the play of 2025. It's kind of hidden, but that's one of their growth vehicles in the company. So for somebody that owns it, is there light at the end of the tunnel? How long is the tunnel? When you tell me when sentiment improves, because they've been doing essentially what they told people that they would do. It's that marginal name when people are buying Suncor and TC Energy and they're looking for a third name. How does a name hit that list? And it just, for now at least, it's not. I think it's challenged just from a sentiment perspective.
Before we get to our next question, one thing I should ask, and it relates to tariffs, is that discount on Canadian oil has been getting wider, presumably
a little. Yeah, a little.
Do you have an outlook on that? Do you expect it to improve? Is any of your view predicated on that?
Tariff aside, we've always thought $12.50. So
is the discount to U.S. pricing,
which is a very healthy level. Very healthy level. Our view is it's a $10 to $15 band. $12.50 kind of splits it. $15 right around now. You've got seasonal weakness. There's ebbs and flows for demand. When the demand is higher, 10. So $12.50, and we've been pretty accurate. And that was a bold call when we made it, because we were in the 21-22 and we were talking like 10 to 12. And so before the tariff noise, we were just under $12 actually. Now we're around 14-ish.
Let's talk Whitecap Resources. This is our next question. Could you please ask Eric about Whitecap Resources? This one has kind of traded in a range in the last couple of months. Held in, I guess, is a nice way of putting it.
It's true of all the mid-caps, really. Like a lot of them have been range bound. We like Whitecap. We don't own it in our main fund. We own it in our income fund because we get the dividend, roughly 7% yield. We can probably make about 12% selling calls on it, so 19% total annualized is pretty good. Again, going back to the main fund, we don't want to have too many mid caps right now. Like we've got big exposure to C&Q. We do own Suncor, less today than we did last week for the reasons that we spoke about. We've been adding to U.S. natural gas, where larger market caps, more relevance, more thematic, more momentum. And then in Canada, like if I'm patient, my clients are patient, but they're only so patient. So you can't own 15 mid caps and doing one of these for sentiment to improve.
Crossing your fingers.
Yeah, if there's less likelihood of catalyst to drive a re-rating. So we have huge weights in like a MEG, a Varen, a Tamarack, a NuVista. We have enough mid cap exposure, but there's nothing wrong with Whitecap.
Okay, we're going to take a quick break. We'll be back with more of your questions. And we're back. Our next question, Eric, is about natural gas. We've gone this whole episode without talking about it. Natural gas is back in a major way. Prices have perked up from a long slumber. This question is coming from Bruno, who's becoming a friend of the show. Some are making an argument that North America is going to be entering a super cycle for natural gas. And the argument is that nat gas is going to be needed to generate power for all of these new data centers, and that LNG would be increasingly used in foreign countries that are now burning coal, LNG, liquefied natural gas. What do you think about the super cycle for nat gas, and what would be the best way to invest?
Yeah. So yes, we're bullish on natural gas for the first time in many, 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 many years. And it's for a lot of those reasons. Gas has always been a domestic commodity. So domestic markets, North America, and then within those, you've got different hubs that have their different supply demand. So like AECO, which is Canadian, the major Canadian benchmark, we have a huge disconnect relative to the US because our storage is bloated. Our producers have been growing, lacking discipline, and growing into the dream of LNG and data centers and AI and all that stuff. So for natural gas, I feel like the Trump presidency is a reset where things are no longer taboo to say, where you can talk about how wind and solar are not great sources of energy. Look, we need it, but because the mix, like the aggregate demand is increasing. And it's interesting looking at natural gas and power. Like power demand in the United States was flat for about 16 years. 2023 was the first year of growth. So whether it's AI and data centers, it's a little early on that, but it's reshoring, it's lack of the efficiencies, population growth. And so there's a call on energy where it's believed that US energy demand will grow by 25% over the next 15 years, huge increase. And so you look at, okay, AI data centers, that needs 24/7 non-interruptible, super reliable power. You can't get that from wind and solar because what happens when the wind's not blowing and the sun's not shining? It should be nuclear. It can't be because of the build cycle is measured in decades. So natural gas, you're seeing massive increase in demand. TC Energy said that for the next, I think it's 10 years, demand for natural gas in North America is going to grow by 40 BCF a day. That's about a 25% increase. So it's a massive increase in demand for gas.
So what's the play? Where do you go?
Well, my fund to begin with. I can finally say, I can't say that on BNN really.
Of course,
but
you can say it here.
So the decision then is, do you go US or Canada? Our decision is to go to the US because those producers have shown much better discipline. Price goes down.
Discipline,
you know what?
How?
If price goes down, they stop drilling. They stop drilling, they stop producing, and they stop flowing it into oversupplied hubs where you get a crumbling in the price. So we have two. We have Expand and EQT, be about 12% of the fund, 6% weights in each. Expand Energy, EXC. It's the old Chesapeake.
EXC?
And they bought Southwestern.
Okay.
And EQT.
EQT, okay.
So our preference is US over Canada for energy exposure. You've got more LNG demand. So Canada, like finally LNG Canada is starting to ramp. It's a little behind. We picked that up when we were in Calgary last week. A couple quarter or two, like nothing huge. So hitting full capacity hopefully by the end of this year. Versus in the US, you've got a Trump presidency where, as much as this drill baby drill nonsense, hopefully we can touch on, it's a joke. I think they're going to try to unlock natural gas, build pipelines, build out the grid, because it's not just oil pipelines that you can't build. You can't build anything in the US up until like in an hour from now. So I think there's going to be a focus on natural gas, the grid, using it as a meaningful power source. So you get more exposure where US LNG is doubling over the next 5 years from roughly 14 Bs to about 26 to 28. Canada, we're a little slow. Yes, you have LNG Canada, but it's just, there's better drivers. Valuation's not as compelling, but it's more likely that you'll have funds flow going to those names. You
said that you sold your largest nat gas position, a Canadian company.
I did.
Which one was it?
You're getting me in trouble.
I know.
Again, third
I
question.
lured out. That's the fun of the podcast.
We sold our tourmaline.
Tourmaline.
That's after a meeting.
Everybody loves tourmaline.
Everybody loves
and everybody
tourmaline.
Loves Mike Rose.
And there's good reasons to do that. Mike's a super sharp guy. I think he's a self-made billionaire. How do you bet against him?
So why did you sell?
We don't like how they continue to grow production in the face of weak prices, because oil, natural gas, it's always set off of that marginal molecule. That one molecule that tips the market into over or under supply impacts every other molecule. And so what we saw in the US was producers were disciplined. They stopped drilling, they stopped growing, and it restored the imbalance of inventories that led to an increase in price. Canada, we have a lot more plays that have liquids in them. So the economics are driven off of the liquids, the condensate, the oil. So you're not as reliant on the natural gas price. But for them, they're more leaner. They do produce more drier gas, not dry, but drier. And yet they continue to grow production. I think they're growing by 7% this year. So we would have preferred that they and industry stop growing production, given a massive discount for Canadian gas relative to US, and just wait. But it just seems inherent in some of their DNA. They have to grow. We didn't want to support that lack of discipline.
Okay, so you're out of tourmaline. You said in your comments, drill baby drill is a joke. Why?
Yeah. Any president cannot impact the ability of U.S. shale to grow. When shale production last year, exit, it was end of 24, end of 23, grew by about 150,000 barrels per day. That's the slowest rate of growth since the rise of U.S. shale. We're seeing maturity of these basins. We're seeing well degradation, well results getting worse. We're seeing companies admit to that. And so we think we're in the twilight of U.S. shale. This will be the last year we think of meaningful growth, meaning 300,000 barrels per day at best. And shale production growth rates should meaningfully decelerate, and with it non-OPEC growth rates as well. So you think about the past 10 years, like non-OPEC supply has grown by 5 million barrels per day. U.S. shale has grown by 6. So shale has been the massive, largest source of incremental barrels, and that's coming to an end.
We got to get to the pro picks, which are your top ideas. But before, I just want to squeeze in this one question. It's about politics in Canada. This one coming from Brian. Let's see if you can do it in 30 seconds.
Sure, yeah.
And maybe I'll get you in the least amount of trouble for this. If Mark Carney wins the Liberal leadership race, would Eric anticipate the Liberal energy policy to stay the same in regard to net zero targets?
Yes, I do. He's on the public record in many, many interviews. In fact, his views are probably stronger than Trudeau's. And so if he were to become prime minister for more than 2 days, like the Liberals win, it would cause some concern for me.
Okay, now it is time for Pro Picks. This is where we get Eric's best ideas. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get to some of these best ideas. Varen is your first one. This is a former Crescent Point. It has been a dog.
It has been.
It's bouncing off of a 3-year low, sports a 6% dividend yield. So why now?
So why now is that we have to set the table. Varen was very acquisitive, and they jettisoned a lot of the old Crescent Point assets. They went into the Montney through several transactions and the Duvernay, and acquired decades worth of drilling inventory. They went on to drill some of the most economic Montney wells ever drilled, not from a rate, but economics. They then said, okay, we have a lot of this running room. There's a frac tool being used in other areas of the Montney that if we use it, we could save like $500,000 to $1 million per well, and over 400 wells, that's a lot of money. So they tried it. Initial results, they got a false positive. So it looked like, wow, the rates are good, saving money. This is great. They then did that on about 14 more wells. Turns out it was wrong. So the well rates were not nearly high enough. In fact, they dropped by over 50%. So the market, very sentiment challenged last year, said, see, they've been acquisitive. The quality of their acreage is not as good as they thought. And the story just imploded. The stock imploded. It's up roughly 30% from the lows. And then we had a front row seat to tax loss selling last year. Mm-hmm. It was vicious.
So tax loss selling, when people have a loss in the portfolio, they decide to sell the stock so they can offset any profits that they have in the portfolio. So it got caught up in that because it was such a loser last year.
Yes. So Baytex names like that were just bludgeoned in December. It was vicious. So what we see is they're going back to a tried and true tool to use, more expensive, but still they're getting really good rates. And we think we're going to have well results by the end of this month on some other pads to demonstrate that the quality of the acreage is as good as they thought. Again, Keegan, my partner, geologist, he spent a lot of time with their technical team. We've had hours and hours and hours of meetings to go through. What do you think? Why do we think that? We've tested it with other producers as well. So we think that there will be well results. And in fact, there's some in the public domain now, if you pull up well results that confirm our view, very, very high rate wells. We also think the company is trying to accelerate releasing a reserve report from the reserve engineers. So if reserves don't fall, if there's no technical revisions, it would mean that the reserve engineers agree with the Crescent Point thesis. And that is, it was not a geological issue, it was just the technology. So we see a company deeply discounted, I'll run through the metrics in a moment, where you've got two short-term catalysts, well results on one pad, a reserve engineer hopefully not demonstrating that there's been erosion in how good the wells are. And then later in the spring, we should get well results from that same pad that they drilled the crappy wells in using the tried and true method. So I look at a stock, to tell me what oil price you want to use, but let's run with 75 because that's roughly, we're trading at 78 now. It's trading at 2.9 times cash flow. an 18% free cash flow yield. Investors are now getting 60% of that free cash flow in the form of buybacks and that dividend that you referenced. We think they will hit their debt target by mid this year, where we will then get 70 to 75% of that free cash flow. And so simple math, they can privatize in roughly 5 years. I'm getting several decades worth of Montney inventory. They used to drill the most economic Montney wells literally in the history of Canada, and they're going back to
that
model.
So put it all together. It's an $8 stock. Where does it go?
Yeah, so price targets, right?
Yeah. I love those.
Yeah, I do. Okay, so we think a mid-cap model should be 4 to 5 times. Let's use 4 times for the sake of argument being, I think, conservative. At $75 oil, 1 year, that's a $14.07 stock. So that'd be 75% upside from here. I do think if we meet a year from now, we're talking about a slightly higher oil price than where we trade today. But let's just run with that. So that would be 75%-ish upside. So I'm getting a CEO who he owned his mistake. He really lived up to it, or lived up to it. He owned it. No excuses. They're back. They're in the doghouse. They have to restore credibility. You've got, I think, near-term catalysts to allow them to rebuild that confidence. And if the stock stays at current levels, the value proposition is so massive that I do think you're going to see more U.S. interest coming up to Canada, where you have companies that were relying on shale for many years that now have an inventory challenge. They have less of it, and the quality of it that they have is getting worse and worse and worse. And the Montney and the Duvernay and a few other plays, because of we're gifted with this resource, a company can come up and get decades worth of a really, really good asset at a discounted price. So either the CEO is going to take care of the valuation problem, or the market will take care of it. Another
one that you like, and it's your second one, that's also, it's not trading quite as low as Crescent Point, but around a 52-week low. Your second pick is MEG Energy.
Yeah.
And this one got punished quite a bit in the fall, right? They had a production outlook that was kind of viewed as disappointing.
Yeah, so they had a new CEO. So Darlene took over from Derek Evans. I like Derek a lot. He made us a lot of money. Like, we've done phenomenally well through MEG. So you have a new CEO, and she's got to put out her vision. And they were telegraphing this, but they are growing. So it's against the Eric Nuttall playbook, but it's modest. It's modest. It's not like they're doubling production. And it's scaled over time because this is long cycle. It takes years to grow production. And while doing so, they're increasing their cash flow per share and free cash flow per share, meaning they can pay us even more. So I look at MEG and I think of it as an asset where they have at least 35 years of stay flat inventory. And unlike shale, the inventory is not getting worse with every year. In fact, it's getting better because they're drilling some better areas. And because it's subjected to tariff risk, it's been getting brutalized. I believe, talking to trading desks, hedge funds have been pretty leaning on it pretty significantly.
Leaning on, I mean what? Shorting it. Okay.
Yeah. And so as I look at it again, okay, 35 years of inventory, that's 35 years of production, cash flow, free cash flow, let's call it dividends, 35 years of dividends. At $75 oil, it's trading at a 14% free cash flow yield now. They're using that, they hit their final debt target, so they're buying back that stock, so they could buy back 14% of their shares per year. And I think one of the biggest opportunities, given the extent of their inventory, is as an investor, you should look out beyond a year. Mm-hmm. And the compounding effect of meaningful share buybacks will inevitably drive a re-rating in the share price. It has to. And so if I look at it for the next 5 years, well, I'll use 70 to be conservative. So we'll shave $10 off. They would be trading at a 10% free cash flow yield, so they buy back 10% of their stock a year. So look at, okay, what does that mean on its trading multiple 3, 4, 5 years out from now? So they would expand their free cash flow yield from 10% to 31% over the next 5 years at a flat oil price. That's solely from modest production growth, but really the compounding impact of buying back their shares. So to get from a 30% free cash flow yield back to 10, because that's effectively, that could be a dividend yield, the stock would have to triple. So it's the reason why we say...
Is that what you see happening?
Maybe.
Okay.
To give me the timeline.
Yeah.
But it's the reason why we've been such a massive advocate for meaningful share buybacks, because I don't want to hope that sentiment improves. Yeah. I need to have a catalyst which a board and a CEO can create from themselves. So a triple over 5 years at a flat oil price is pretty compelling. And we think that can happen in a shorter period of time.
So, I mean, it's up today because it looks like the prospect of tariffs is like somewhat watered down.
Right.
How volatile do investors have to, what kind of volatility do investors have to be prepared to deal with on tariff headlines alone?
High, I would say. Yeah,
so it's really in there in the eye of the storm.
Things are going to be volatile.
The third pick is Athabasca Oil. This one is held in.
Yeah, it's done phenomenally well.
And why do you like it here? How much upside?
So we have a backstory. People have joked in Norway, there's a wanted sign with my face on it because we bought 10% of the company years ago from Statoil, which is now Equinor, at 17 cents. The stock now is $5.40. Oil was at $54 at the time. We thought oil was going to go to 60. And what we saw in their business was massive.
How long ago was this?
Oh, this is 4
years ago?
5 years.
Okay.
Time flies.
That's quite a move,
we both have young kids, so time flies very quickly. Why we like it today is they've exercised my playbook perfectly. They eliminated their debt. They now have like net cash. And they're using 100% of their free cash flow just to go to share buybacks. You can debate how many decades worth of inventory. Honestly, it's kind of moot. They think it's higher. I'm going to go with 50 years. Sure, it's a lot. Okay, so it's truly, when you look at out 2, 3, 4 years, the compounding effect of buying back those shares again has to drive a re-rating. And so when we look at it, they're going to pay us this year 10% at 70, 13% at 75, 15% at 80. Look out to 2026, hold those oil prices the same, just from the increase, a very, very modest production growth, really the impact of compounding share buybacks. At 70, I'll go from making 10% to 12% a year. And so it's that, again, that compounding effect. What's the value of that last share? Because I'm going to be the guy owning it on behalf of my clients. And so we can see a massive re-rating. So it's trading at 4.3 times, 3.4 next year. Again, 10 to 13% free cash flow yield. No balance sheet risk, decades and decades and decades worth of inventory.
So trading at $5, where does it go?
Yeah.
You come,
I hate the price targets though.
Okay. I know you do.
I would say,
but our viewers love them. It's easier for them to conceptualize.
So tell me oil price. So 1 year out at 70, we would say fair value is about $7 a share.
Okay, so higher.
At 75, about 8, and at 80, about 9.
Okay,
give or take. That's 1 year. But again, if you have the ability. As a retail investor, you have a huge advantage over institutions. You don't have to worry about daily redemptions, daily inflows or outflows into the fund, liquidity constraints, all these different things. And if you can look out 5 years, and if you can buy an Athabasca, a MEG, a Crescent Point for that matter, where you can benefit from your ability to be patient and benefit from the compounding, like Einstein said, the most powerful force in the universe is compound interest. It's the compounding impact of share buybacks year after year after year after year, where you can almost guarantee a significant re-rating because the value of those remaining shares is getting more and more and more valuable with each passing year.
I've asked pretty much every question I've wanted to, but one thing that hasn't come up, so all of your picks are producers. Where do the pipelines fit into this? Are they a relative safe place? I think RBC was out with a report saying if you want to hide out from some of this tariff concern, you could hide out in a TC and an Enbridge and a Southbow.
If you want to hide out, why bother with energy? Like there's a lot of other things to invest in. You can buy Trump's meme coin, for example, where somebody apparently made $150 million on the weekend. But
that's right.
Like if you're truly terrified about tariff risk, just step back and we'll have clarity in the next couple of weeks. If you know you can handle a little volatility, we think, and we're being rewarded by this today, but we think it's created a lot of opportunity where you can buy businesses that are now on sale with, in some cases, no debt, decades worth of inventory, out of favor, catalyst coming in the next, in some cases, the next couple of weeks to month that can drive a rating, all of these different things. But so the pipes, like midstream did phenomenally well last year. I think most of that was you had risk off market, and with interest rates, falling, you get this dividend, the value of that dividend stream becomes more and more valuable. So the midstream companies did very well. We don't own any. We find more compelling. You can buy producers with equally, in fact, way better balance sheets. A lot of the pipes are like 4 or 5 turns of leverage, like 5 times debt to EBITDA. Well, what's the risk in another business where you've got asset tenure similar to a pipeline, different business, but similar, with no debt and they're paying you a higher dividend, I would rather invest in that.
Okay, so how would we sum up this last hour? Three words. What's the catchphrase? Your signature catchphrase is?
Well, we remain bullish.
We remain bullish, and that brings us to our swag giveaway. Are you ready? This one I'm the most proud of. So we give away a piece of swag, as everyone knows, to our guests, and we try and make it custom.
Oh, that's awesome. I've got the
What
hat.
do we have?
I love it.
We remain bullish. There you go. Thank you so much.
Thank you very much.
Eric Nuttall
great.
for joining us.
My pleasure. Happy to spend the time with you.
It's been so wonderful. Don't miss the next episode of In the Money with Amber Kanwar. We've got John Zechner and Francis Hordelsky, people that are very familiar to longtime watchers of business news. And I can't wait for you to listen to that episode. We talk a lot about the markets and a lot about history. That episode comes out on Thursday. You can send your questions in to questions@inthemoneypod.com. You can find us everywhere on social media at In the Money Pod on Instagram, Facebook, X, TikTok. Check out our website, www.inthemoneypod.com. We'll catch you next time.